The following hedge fund video has been brought to you by the HFG. The hedge fund group provides premium service, along with online training and certification for hedge funds, called the Certified Hedge Fund Professional, also known as the CHP designation.
Hello, this is Richard Wilson, and today we're going to go over the media portrayal of hedge funds. Our firm works with a lot of media and press professionals. We've worked with over 100 people from Business Week, Wall Street Journal, Seeking Alpha, Alpha Journal. We've worked with a lot of different professionals, and there's a lot of journalists who do a great job, and they know the industry better than I do, and lots of them have worked in the industry. So this is not meant to say that all journalists are horrible at doing their job when it comes to hedge funds, but there are some misconceptions caused by the general media. And for every journalist who does have great insights on hedge funds, there's probably 10 to 30 which have never worked in the industry or talked directly to a hedge fund manager, and it can cause a lot of misunderstandings, both for professionals in the industry and especially for those that have never worked in the industry or with hedge funds. So today we're going to cover some of these misconceptions, why they exist, and what the top 3 misunderstandings about hedge funds are. So first off, usually it's only the top 1% of hedge funds that are the largest in assets, or the bottom 1% of hedge funds in terms of ethics, which make it to the front cover of the news. And let's look at why. News companies are made to have stories about very important events or about extreme things happening, so they can have very extreme headlines that draw more readers to their newspaper. It is extreme if somebody makes $2 billion in profit, but guess what? That's usually the firms which manage several $100 million were already $1 billion plus. Or it's a big deal if somebody has stolen $42 billion in investor assets, but that's because they were one of the least ethical pyramid scheme hedge funds in the whole industry, and probably technically not even a hedge fund, but they kind of look like one, so they're labeled as a hedge fund in the news. And because they're at that bottom 1% of ethical professionals in the industry, they're what you hear about in the news. So it's really a polar industry. You hear about the largest hedge funds and the worst hedge funds in terms of how they're ran operationally and ethically. So that's one of the reasons why there's lots of misunderstandings in the industry. There are 3 main misconceptions I wanted to go over here today, just so if you hear these, you can just know that they're not true or mostly not true. Lots of misconceptions have some kernel of truth, but they're not true nearly to the extent to which the media portrays them as. So the first one is that hedge funds are large multi-billion-dollar investment vehicles that can destroy companies. That's a misconception, that hedge funds are these huge, giant investment groups which can just destroy publicly traded companies. And the truth is that while the largest hedge funds do manage a large portion of the industry assets, most of the hedge funds are made up of $1 million to $200 million in assets in their portfolio. That makes up most hedge fund managers. They're not huge multi-billion-dollar funds. And most hedge funds, if they're managing $1 to $200 million, let's say the fund is a $100 million fund, and the fund has 30 securities at a time, that means that one investment would be $3 million. That's very, very low in terms of being able to shift or destroy value in a publicly traded company. And it's just not realistic that's going to have any great effect up or down in shorting or purchasing long securities in a company. So that's definitely one misconception. Another misconception in the industry is that hedge funds are not regulated, that we should open a hedge fund because they're unregulated, or well, hedge funds, we need to regulate them because right now they're totally unregulated and they're destroying the marketplace, or they're taking advantage of something. The reality is that 95–99% of all hedge funds are regulated. They're regulated at the asset level and what they invest in. If they invest in securities, they're regulated by the SEC. If they're investing in futures or commodities or currencies or real estate, then they're regulated by the agencies which oversee those industries. If they're investing in something like domain names, there's even a regulator organization over domain names. I mean, almost anything has somebody at the asset level regulating it. It's just that directly, hedge funds don't have the same regulations as some other investment vehicles. And that's why there's some investor protections and rules on who they can go after in many places in terms of a potential investor. That's definitely a misconception. Hedge funds are regulated at many different angles already. Next, the third misconception is that hedge funds are always committing fraud and blowing up their funds. Let's take the first example, fraud. Less than 0.1% of all hedge funds have committed fraud or been even accused of committed fraud. Some estimates are that there's 10,000 hedge funds in the industry, but that's based on hedge fund databases. Many hedge funds outside the United States don't put their information in databases. Some large hedge funds stop completing their information in databases, and many hedge fund startups don't even bother until they're 2 or 3 years old. So there's far more than 10,000 hedge funds in the industry, but even if you think there's only 10,000, less than 0.1% have ever been even accused of fraud. So that's definitely a misconception, that hedge funds are these fraud, shady, gray vehicles where, illegal things are always happening. There's many, many hard-working professionals in the hedge fund industry, and for every one that gets accused of committing fraud, there's hundreds which have never done so. The second misconception connected to this is that hedge funds are always blowing up. Their performance is always, blowing up, they're going under. While there is some bias in who reports what to the databases, the truth is that in 2006 there was a study by Capco showing that most hedge funds actually fail because of operational failures. They lose a key member of their team. They have a breakdown in their accounting and auditing procedures that disrupts their track record. Something operationally breaks down, and that's the reason why they go out of business. Lots of hedge funds do fail, but it's not always because of performance or because the fund is blowing up due to poor performance or redemptions due to poor performance. Lots of times, more than half, it's due to operational reasons and challenges like cash management, which any business faces. So I hope that this video helped clear up some misconceptions that you may have if you're a consultant to hedge funds, or you're a journalist working with hedge funds, or a student looking to work in the hedge fund industry. These might be things which you've read many times over in the news, and so you just kind of naturally have this image of what hedge fund managers are or are not, and these can be some misconceptions that are very common. So I hope these clear it all up, and thank you for your time.